Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today we're diving into Watsco, ticker WSO,
Right.
a company that operates in an industry a lot of people might just dismiss as archaic, maybe even dull.
I mean, that's the perception for sure. The distribution of heating, ventilation, and air conditioning products.
Exactly. You think trucks,
Yeah.
you think warehouses, big metal boxes. That's it.
And that is the crucial, almost deceptive surface level of the business. But for us, the financial story, it pivots entirely when you look beneath the hood.
Okay.
Watsco isn't defined by its trucks. It's defined by its deep, really sustained commitment to technology.
So they have to stop seeing them as just a logistics company.
Precisely. Stop seeing them as just moving white equipment and start viewing them through the lens of their, $250 million technology platform.
And that platform, that's the whole competitive edge.
It is. It absolutely is.
And that's really the thesis we are exploring in this deep dive.
Yeah.
This idea that Watsco is fundamentally a technology company.
That just happens to sell HVAC.
Right, and they're using that technology to aggressively transform their traditional, very decentralized family of families model.
Turning it into a collaborative, data-driven juggernaut, something really designed for the 21st century.
And this isn't just a slow burn, right? This transformation, it's being driven by a really ambitious corporate objective.
Oh, it's incredibly ambitious. They call it the 10, 30, and 5 plan. It's Watsco's internal moonshot, really.
So that mission, targeting $10 billion in sales, 30% gross margins, and 5 inventory turns, that's what's going to guide our investigation today.
A huge set of goals.
Our deep dive mission is to dissect how they even plan to achieve these numbers, specifically by layering on enterprise-grade logistics, which they call Hydros.
And a unified procurement marketplace, SupplySync.
All of that over their colossal network of nearly 700 locations across North America. It's a complex strategy and, demands we get into the details.
To really appreciate this current technological push, you have to grasp Watsco's foundational history.
It's important context.
It is, because it explains why they are structured the way they are today. Their origin story is critical because it wasn't some, standard trajectory of organic growth.
No, it was a calculated, very opportunistic pivot that happened almost, by accident?
Pretty much.
Okay, so let's trace this back. Watsco didn't start as a distributor. They started as a small manufacturing business.
With a tiny market cap, something like $4 million.
Yeah, we're talking about 1989 here. And the pivotal moment arrives when the chairman gets a prospectus from Merrill Lynch for a regional distributor.
Jamere Distributors, and it was located literally just up the road from them.
And his first reaction was just to dismiss it.
Right. The lore within the company is that he actually threw the prospectus in the trash. He believed, manufacturing and distribution were completely distinct businesses, not worth the trouble.
But something made him pull it back out of the trash.
Something did. He retrieved it, drove up to the auction, and decided to investigate. And here's the incredible twist.
He gets there.
And he finds out he is the only bidder.
The only one. Just one bid.
Imagine. And that single acquisition of Jamere, it just fundamentally pivoted the entire company.
They realized that the massive, recurring, replacement-driven nature of HVAC distribution was just a superior business model.
Absolutely. They sold off all the manufacturing assets shortly after that and dedicated the whole enterprise entirely to distribution.
And that pivot just led to an explosion of growth through acquisition.
A huge one. Watsco today is this amalgamation of roughly 70 acquired family businesses.
But they haven't merged them into one giant soulless brand.
No, not at all. Those 70 businesses operate today as 10 primary distinct business units. And this massive scale lets them serve over 350,000 contractors in North America, operating through almost 700 physical locations.
Okay, but this is where the business model really sets itself apart, this family of families structure.
It's fundamentally decentralized.
We often talk about consolidation in the market, but Watsco's approach, it seems like a very conscious counterpoint to the standard private equity model.
Exactly. When a typical PE firm acquires a regional distributor, what's the first step?
Find synergies.
Which usually translates to gutting the staff, eliminating overlapping functions, consolidating leadership, and often, killing the local brand identity immediately just to save a few bucks.
Watsco takes the absolute opposite approach.
They do. They retain the local brands, the established leadership, and that unique cultural identity. They inject capital, they inject resources, but they leave the operational soul of the company completely intact.
So they're buying great local entrepreneurs and just letting them continue to run their business.
That's the pitch. And this commitment to culture is best illustrated by the NNS Supply acquisition.
Right.
NNS Supply was started by a junk man in the Bronx back in the 1930s. It was run by a father, Wayne, and his daughter, Stephanie, a fourth-generation leader.
And when they decided to join the Watsco family, they had this one specific, pretty unusual question about an annual tradition they had.
The famous silly hats tradition.
You have to tell this story.
They asked if they could continue their annual Christmas visit to the original branches where the top 4 leaders wear silly hats and flashing necklaces.
And Watsco, this multi-billion-dollar publicly traded corporation, what did they say?
They immediately approved it. No hesitation.
That's incredible. It's a seemingly small detail, but it's a huge cultural signal.
An enormous one. It says, "We value your local flavor more than we value a sterile corporate image."
And Stephanie, the daughter, she specifically noted that after the sale, NNS Supply lost 0 customers.
And, maybe even more tellingly, 0 employees. The local relationships, which are everything in B2B distribution, they remain completely undisturbed.
So the value proposition for these family businesses is clear. Watsco relieves them of what they call the ugly part of the business.
Right, the administrative burden, which can be crushing.
Think about it. Navigating complex healthcare negotiations for a dispersed workforce, signing national fleet contracts, administering 401k plans.
All of that gets handled by Watsco. It allows the entrepreneurial leaders to focus purely on their core mission: wholesale distribution, customer relationships, and local growth.
But this decentralized structure, it creates an immediate and very critical challenge.
It does.
While it preserves culture, how do you achieve economies of scale? How do you get cross-company efficiency when you have 70 independent businesses all running their own P&Ls?
And that is where the technology infusion comes in. It's the necessary centralized intelligence you need to manage a decentralized federation.
So the technology is the real moat here.
Without a doubt.
We mentioned it was a deep investment, something like $250 million. That figure itself speaks volumes.
It's a capital investment that traditional regional competitors they simply cannot afford to make.
And the need for this became obvious about 15 years ago.
Yeah, that's when management had this sort of sobering realization that all their mission-critical business intelligence, every transaction, every piece of inventory, every customer profile was locked away.
Locked away in what, 16 different fragmented, totally incompatible legacy ERP systems.
Spread all across those various business units, it sounds like a nightmare.
It sounds like operational chaos, a nightmare for any leader trying to see the forest of the trees.
So the first step wasn't about building some flashy front-end app.
No, it was painstaking foundational engineering.
Exactly. Centralizing all that disparate data, the attributes for 200,000 SKUs used, customer purchase histories, inventory locations, into a common data model and a singular massive data warehouse.
This was the moment Watsco stopped just selling appliances and started, in a way, selling data.
That's a great way to put it. Before this, local leaders often just relied on intuition.
I've been doing this for 20 years, I know exactly what to carry mentality.
Right. And they'd only get a single monthly P&L statement, which is just a rearview mirror look at their performance. It's not actionable.
The cultural shift from that must have been massive.
Huge. They transitioned from intuition-based selling to a data-driven culture. Management even affectionately calls the leaders who have really embraced this change data snobs.
Data snobs. I like that.
They now demand specific metrics, real-time feedback, and granular insights that were just impossible before.
And this wasn't just some internal benefit, right? This translated directly into gaining market share.
It did. Market analysis attributes this deep, persistent investment in data with capturing an estimated 200 to 250 basis points of market share over just the last 3 years.
That is the definition of a competitive moat. It's a structural advantage based on capital expenditure that the smaller players just cannot replicate.
They can't. That centralized data, that $250 million investment, it's not just a cost line on a spreadsheet.
No, it's the intellectual foundation for everything that comes next.
And it's what allows them to move into this next, even more ambitious phase of collaboration.
So if the first couple of decades for Watsco were all about buy and build and centralizing data,
this current phase, phase 2, is all about collaborate and conquer.
and company chairman really set the stage for this new period with a challenge, didn't he? Dream Plan 2.
He did.
The famous and, potentially transformative new mantra, 10, 30, and 5.
Right.
Let's just pause and appreciate how ambitious these targets really are. They don't just represent incremental growth.
No, they require deep structural change.
Okay, let's break it down. 10 billion in sales,
Yeah.
up from the current 7.5 billion.
That's a 33% increase in top-line revenue. A massive jump.
Then 30+ gross margins, that's up a substantial 250 basis points from their current record of 27.5%.
Which is already a record.
And finally, 5 inventory turns. A dramatic jump from the current 3.6 to 3.7 turns.
And that third number, the inventory turns, that is particularly aggressive for a distribution business that has to deal with seasonality and all this regulatory uncertainty.
So the central conflict is, how do you achieve this exponential value capture, the 10 billion and the 30% margin, without sacrificing that entrepreneurial spirit of the local family businesses?
That's the tightrope they have to walk. And when management gathered their business leaders to ask how this could be done, the answer wasn't centralized.
It wasn't top-down.
No. The overwhelming consensus from those entrepreneurial leaders was the need to collaborate more across business units.
So they recognized it themselves.
They did. They saw that the limitations were no longer size, but communication and coordination. And that consensus, it directly mandated the technological and logistical initiatives that make up the rest of this plan.
And collaboration, it starts where the money is. The margin. To hit 30%, they needed true margin alchemy. And this brings us right back to the power of that centralized data model.
Specifically through the implementation of an AI-driven tool called Pricefx.
Before this, what was the pricing environment like?
Management called it scary.
Scary.
Scary. Because the business units operated in silos, pricing decisions were they were complex, hard to administer, and made across different departments, sales, finance, local branch leaders.
And that resulted in huge variability.
Massive. They were selling the exact same SKU at prices that were, and this is a quote, literally all over the map.
That variability isn't just sloppy, it's leaving a lot of money on the table.
But the variability also contained the opportunity. The solution wasn't just a blanket price hike that would destroy customer goodwill overnight.
No, the solution was implementing Pricefx, this highly specialized AI-driven pricing optimization engine.
And this is where we need to get into the technical depth a bit. Pricefx isn't just looking at cost plus markup.
No, it's way more sophisticated.
It ingests all that centralized data, customer segment size, geography, seasonal demand, local competitive intelligence, the full attribute profile of all 200,000 SKUs, and it runs thousands of simulations.
To do what?
To determine the optimal price for every single product, for every customer, and every transaction, to maximize the dollar value of the margin.
It's sophisticated differential pricing. And it's only possible because of that initial $250 million data investment.
Exactly. It's about being able to charge customer segment A in Dallas a slightly higher price because they show low price sensitivity, while making sure customer segment B in Miami stays competitive.
It brings real discipline to a process that was previously based on a handshake and a gut feeling.
And this shift introduced a significant cultural change. Leaders had to accept that an algorithm might know better than their 20 years of experience.
I can imagine that was a tough pill to swallow for some.
But the results were undeniable. This new discipline and sophisticated pricing led to a 200 basis point expansion in gross margins over 3 years. That proves that the technology created genuine pricing power, even in a competitive, cyclical industry.
So the point isn't just raising prices across the board.
No, it's about getting the right price for the right customer segment at the right time to maximize margin dollars.
It ensures they don't miss a high-margin sale because they price too low, and at the same time, it ensures they don't lose a valuable customer because they price themselves out of the market.
It's surgical.
Okay, so now let's pivot from maximizing margin to accelerating sales, which is powered by this platform, OnCall Air.
Right, and this tool solves an almost comical operational failure that has plagued HVAC contractors for decades.
You're talking about the paper towel method. We have to spend a moment on this because it just highlights the absurdity of the pre-digital era.
It is exactly what it sounds like. A service technician, probably standing in a hot garage or a dusty attic, would literally sketch out a quote on a sheet of paper.
Or maybe a paper towel if that's all they had.
In front of the homeowner. The whole process was entirely manual, cumbersome, and just inherently sales limiting.
I mean, think about the complexity that contractor had to manage in real time.
It's immense. Calculating the price of equipment and labor, manually trying to figure out if the system qualifies for local utility rebates.
Federal incentives like the old IRA tax credits, AHRI compliance.
Which is a technical certification for its efficiency rating. All of that was usually done back at the office, which leads to delays and, missed sales opportunities.
So OnCall Air just completely eliminates that friction.
It does. It's a digital proposal generation tool.
Right.
It lets the contractor create branded, highly professional, and visually engaging proposals on a tablet right there in the homeowner's living room.
So it's less like a, quote, generator and more like an education tool.
Precisely. The contractor can now immediately offer side-by-side comparisons. Up to 4 options, from a simple repair all the way to a high-efficiency replacement system.
And the homeowner can then review detailed videos, spec sheets, integrated financing options, and see the exact rebate amounts instantly.
The key is that it shifts the conversation from just how much to which option gives me the best long-term value.
And the metrics, they prove this approach works.
They do. The platform has already processed a staggering $1.7 billion in gross merchandise value, GMV.
That's incredible. And for the top adopters, the results are transformative.
Legacy service partners, for example, they reported a phenomenal 64% close ratio using this tool.
64%. That is a massive lift in sales efficiency.
But the real strategic win for Watsco is in the product mix.
Okay.
Customers using OnCall Air see a product mix that is 2 times richer in high-efficiency systems.
Why is that?
Because the tool transparently presents the financial benefits, the energy savings, the financing of the premium equipment to the homeowner. It results in a 70% upsell rate.
And don't forget the high margin attachment rate.
Right, a 25% attachment rate for recommended add-ons. Things like air quality devices, smart thermostats, or extended maintenance contracts, these are pure profit drivers.
And here's where the data integration gets really intelligent. The breadcrumb trail.
Yes, the platform provides this digital breadcrumb trail. So if a homeowner gets the proposal and then logs in at 4 a.m. the next morning to look specifically at the top-tier high-efficiency options,
Contractor gets an alert.
the contractor gets an alert. This allows for incredibly targeted follow-up. It transforms general salesmanship into a sophisticated, data-informed sales machine.
That level of insight is just unattainable for a traditional distributor.
Impossible. It's essentially empowering the small contractor to operate with the sales intelligence of a massive e-commerce operation.
So this one piece of technology is driving both volume with the close rates and margin with the upsell mix.
Exactly.
So we circle back to that core conflict we talked about, how to achieve 10, 30, and 5 through collaboration, not centralization.
Right. And this isn't Watsco forcing business units to merge departments or anything like that.
No, it's the business unit leaders themselves voluntarily choosing to share resources.
Because the data which Watsco provided shows them the significant financial upside of operating at scale.
And management formalized this strategy into what they call the three-legged stool of collaboration.
A simple, powerful framework.
The 3 legs are buy together, supply chain together, and sell together. Let's start with leg 1, buy together.
Known internally as VCR vendor consolidation and rationalization.
And this is all about leveraging Watsco's immense, $7.5 billion in aggregate purchasing power?
It is. The old way, the as-was, maintained that decentralized model even in purchasing.
So Watsco Corporate would negotiate high-level strategic deals with the big manufacturers.
Right, things like annual rebates or payment terms. But the actual day-to-day transactional purchasing decisions and vendor relationships happened independently within each of the 10 business units.
So that meant that while they had theoretical scale, they didn't really have optimal commitment.
Exactly. A business unit in the Northeast might be splitting its purchases among 30 or 40 different small accessory suppliers. And that fragmentation meant they just weren't getting the best possible programs or pricing.
So the new way, the as-will-be, is different.
It requires the business unit leaders to meet and strategically decide together which vendors will be prioritized.
So they gave an example of thermostats.
They did, narrowing down thermostat and control suppliers from 30 to 40 different manufacturers to just 5 or 6 primary strategic partners.
That is a huge internal shift. It requires a lot of trust among those local leaders.
It does, but the benefit is immense. By committing all $7.5 billion of purchasing power to fewer key partners, they move beyond just chasing simple transactional discounts.
What do they get instead?
They get access to meaningful strategic programs,
Yeah.
better payment terms, enhanced freight allowances, shared inventory rebalancing rights during a volatile market, things like that.
So they're acting as a singular, massive, highly committed customer.
Which ensures they have stronger alliances and better inventory positions during supply shocks, which is a definite competitive advantage over the smaller players. VCR is purely about maximizing that scale benefit without destroying local autonomy.
Okay, let's move to leg 2. Supply chain together. This is the operational engine designed to attack the hardest target in that 10, 30, and 5 plan.
Hitting that aggressive 5 inventory turns.
And the initiative is called Hydros.
Right. And that 5 turns target is a significant undertaking. They're currently stuck at about 3.6 turns. Moving to 5 turns unlocks hundreds of millions of dollars in working capital.
And in a cash flow intensive distribution business, that liberation of capital is fuel for M&A and dividend payments.
For sure. So Hydros is the solution. It's a shared cross-business unit master distribution center, or DC, dedicated specifically to high-margin, low-velocity parts and supplies, not the main HVAC equipment.
Why focus just on parts and supplies?
Because those products, filters, controls, private label items, they often carry the highest gross margins, but are really difficult to manage efficiently in a decentralized model.
So if a local branch has to hold a year's supply of some niche filter, that capital is just dead.
Exactly. The Hydros DC was built as a greenfield operation, meaning they designed it from scratch using best-in-class logistics principles.
And it's designed to be flexible and highly scalable.
Very. It's capable of ramping labor and physical space up or down by a full third based on highly seasonal demand. And critically, it runs on 98% digital, no-touch transactions.
Which minimizes human error and maximizes speed.
It does.
Can you walk us through what 98% digital auto-touch actually means? Are we talking about robotics here?
Not necessarily heavy robotics, but comprehensive automation integration. It means when an order is placed by a local branch, the system instantly validates it, routes it, picks it, packs it, and ships it without a person ever having to manually verify the order.
Or input a tracking number, or reconcile inventory, gives a physical count.
Right. The system manages the flow using sensors, conveyor belts, and automated packaging machines that are all linked directly to the central ERP. This speed and accuracy are crucial for replenishment.
And this efficiency, it directly benefits that small local branch, say the one in Paducah, Kentucky. How does it help them?
It allows the branch in Paducah to carry a massive breadth of product selection, including those high-margin private label items and those low-volume niche SKUs. They might only sell 5 of a year.
Ush.
Previously, to stock that item, they might have been forced to buy a full box of 100 units from a vendor, locking up all that inventory capital.
But now
Now they can order just 10 units from Hydros, receive it fast, consistently, and reliably. They maintain selection without the capital commitment.
And internally, the Hydros business unit itself has already hit 6 turns.
It has, which proves that the goal of 5 turns is entirely feasible when you run it through this optimized model.
Okay, finally we get to leg 3, sell together. This is the ultimate expression of collaboration. SupplySync.com.
Their new enterprise procurement marketplace. This is all about penetrating the largest, most difficult customer segment.
Hey, who's that?
Institutional enterprise customers. We are talking about massive organizations here.
Like hospital networks, national pharmacy chains.
Large multifamily property managers, or maybe a national quick service restaurant franchise. Clients with really complex needs. They're multi-brand, multi-geography, and often multi-trade, so HVAC, plumbing, and electrical.
Their operational pain points must be immense, dealing with hundreds of local vendors all across the country.
They are massive. Rob from Legacy Service Partners, a large contractor, he famously summarized the need by saying they just needed one throat to choke.
I love that.
These large customers, they suffer from highly fragmented billing, wildly inconsistent logistical commitments across different regions, and just zero visibility into their overall spend or service consistency.
So SupplySync.com is designed to solve exactly that.
It is. It's an enterprise-grade procurement marketplace that acts as a single interface for all Watsco locations. It harmonizes invoicing, offering single pay, regardless of which of the 600-plus locations filled the order.
And it enforces consistent logistical commitments, which has to be paramount for these national clients.
Absolutely. They even offer custom-branded mobile apps for the institutional teams in the field, so maintenance staff can order standard replacement parts or schedule service with corporate controls.
And crucially, the platform provides the corporate client with centralized data and visibility.
The exact same intelligence Watsco uses internally so they can manage their national fleet efficiency.
And once again, the technology backbone is the enabler here. SupplySync is only possible because of the SAC they already built.
The product information management system, the Pricefx engine, the e-commerce framework, all of it.
And what's particularly forward-looking is that SupplySync is Watsco's first AI-first development program.
That's right. This means they are leveraging large language models, LLMs, and generative AI, not just for, customer-facing chatbots, but internally, to accelerate coding, design, and quality assurance.
Give me an example of that.
For example, using AI to rapidly integrate new supplier product data into the PIM system, or generating automated test scripts for the platform's security.
That is a huge claim for a company that sells HVAC. So what's the bottom line upside of this investment in SupplySync?
It unlocks massive, expanded share of wallet with the most valuable, stickiest customer segment in the industry. But more importantly, it drives a critical mix benefit.
How so?
Institutional customers buy huge volumes of high-margin, non-equipment parts and consumables. By making procurement frictionless, Watsco substantially increases its share of those lucrative sales.
Moving them closer to that 30% gross margin target.
Exactly.
So the three legs, VCR, Hydros, and SupplySync, they're clearly interdependent. Each one builds on the foundation of that $250 million technology moat. But now we have to turn to the financials and the market reality, which is currently far from serene.
Okay, let's move to the current financial picture using the Q3 2025 results.
This is where we see that fascinating contradiction of a technology-enabled business operating in a cyclical, regulation-heavy industry.
It is. But first, we have to acknowledge the fortress balance sheet.
And the fortress label is not hyperbole here.
No, it's not. Watsco proudly maintains zero debt on its balance sheet. This places them among only a handful of publicly traded companies, I think 3 Fortune 500 companies by their count, that are able to claim this status.
That is phenomenal financial discipline. And they don't just have zero debt. They're sitting on a massive cash war chest.
Holding $640 million in cash, and it often fluctuates up towards $700 or $800 million.
And that balance sheet strength gives them immense M&A optionality, which has to be crucial in this volatile environment.
It's critical. When the market is under stress, like it is now with the regulatory changes we'll talk about, capital-constrained competitors start to struggle.
So Watsco is perfectly positioned to acquire accretive businesses at favorable multiples, using cash rather than expensive debt.
And they've already done it. They executed 2 such acquisitions in 2025, Hawkins HVAC and Southern Ice Equipment Distributors.
Okay, but let's introduce the critical analysis here. The risk side of the zero debt coin. For an informed investor is holding $640 million in cash and zero debt in an inflationary rising rate environment, actually efficient capital management.
That's a very fair challenge. Some analysts would argue that capital is lazy if it's not being leveraged, and that Watsco is potentially missing out on higher returns by not utilizing cheap debt for expansion or large share buybacks.
But Watsco's philosophy is different.
It is. They view that cash pile as strategic dry powder. It's insurance against major systemic shocks, and it's a weapon for M&A when the market is weak, which is exactly the cycle we are in right now.
So they prioritize long-term certainty and strategic agility over short-term financial engineering.
That's the trade-off they're making.
Okay, that distinction is important. Now, let's look at the contradiction in the Q3 2025 results. This is the ultimate proof of their technology moat.
The contradiction is stark. Watsco achieved record gross margins of 27.5%.
A record.
And generated a record $355 million in operating cash flow for the 9 months ended September 30th, 2025. This shows financial strength and improved profitability.
Yet this happened despite significant revenue weakness. They reported a 4% dip in overall revenue.
And equipment sales, the big, expensive white boxes, saw an even steeper 6% drop in the second and third quarters of 2025.
This margin durability, this is the single most important piece of evidence supporting the thesis that their technology investments, especially Pricefx, are creating genuine structural pricing power.
It has to be. In a distribution business, when volume slows down, margins traditionally contract violently because of inventory pressure and competition.
But Watsco's margins expanded, or at least remained flat at record highs.
That's the technology moat holding strong.
And they're also fighting an internal battle focused on inventory normalization, which relates directly to that 5 turns goal.
Oh, yeah. During the supply chain chaos of the pandemic, inventory levels just soared to $2 billion.
Which absorbs a massive amount of working capital.
It does. That inventory level has started to decline. It's closer to $1.8 billion by the Q3 earnings call. But management is intensely focused on freeing up the rest of that working capital.
And this ties right back to Hydros. They need to be sure they have the right products in the right places, not just excessive stockpiles of commodity items.
Exactly.
However, the environment they're operating in is defined by significant regulatory and economic volatility. Let's start with the A2L transition, a massive industry change happening right now.
The A2L transition is highly disruptive. The industry is moving from the long standard R410A refrigerant to new, mildly flammable refrigerants known as A2Ls.
And this isn't just a simple gas swap.
Not at all. It requires entirely new equipment designed to handle the properties of A2L.
And the complexity dramatically increases the cost of replacement for the homeowner.
It does. Because of differences in oil and material compatibility, A2L refrigerant typically requires replacing not just the outdoor condensing unit, but the indoor coil as well.
So you're tearing into the infrastructure of the home, which drives the total replacement cost significantly higher and increases the complexity for the contractor.
And this technical hurdle is happening at the same time as extreme regulatory uncertainty.
The Inflation Reduction Act tax credits, which were a significant incentive for high-efficiency replacement, they were eliminated.
By the one big, beautiful bill signed on July 4th, 2025, and made effective December 31st, 2025.
So on one hand, the cost of replacement is going up because of A2L complexity, and on the other, the financial incentive to replace the unit, the tax credit, is disappearing.
It's a headwind convergence that creates chaos in the market.
And on top of that, we have to layer in the macro factors.
Right. Consumer confidence is near record lows, the housing market is slumped, and high interest rates mean financing that $10,000 to $12,000 replacement system is more expensive.
All of this is causing consumers, particularly in non-Sunbelt regions where the replacement urgency is lower, to default to just repairing their older 410A systems,
rather than committing to a full replacement.
So management openly stated this cyclical trough, made worse by the regulatory chaos, is impacting unit volumes.
Down as much as 10–12% in the market generally.
So how does Watsco manage the inherent inventory risk during this period? They have to carry both the old 410A systems for repairs and the new A2L compliant systems.
And that is precisely why the Hydros initiative and the overall focus on 5 inventory turns is so critical right now.
Okay.
Watsco is using its centralized data to anticipate regional demand for both old and new systems. It mitigates the risk of being stuck with obsolete 410A inventory, or conversely, being short on the specialized A2L systems when the replacement cycle finally snaps back.
So they're using data to manage risk in a period where traditional distributors are just guessing.
They are, and management's perspective is clear. These downturns are cyclical and short-lived.
So Watsco is using this volatile period to gain market share by becoming structurally stronger,
ensuring their digital capabilities will drive accelerated growth when the market finally achieves what they call serenity.
So to synthesize Watsco's strategy, this balance of local autonomy with centralized power, I think the best framework is the modern franchise analogy.
I agree. It captures the essence of their unique structure perfectly.
And this analogy is key because it perfectly addresses that challenge we raised earlier. How do you get scale efficiencies without destroying the culture of 70 separate businesses?
Right. Historically, those 70 acquired business units were like a collection of independent diners.
Each with its own local chef, its local flavor, its own suppliers, its own unique way of running the business.
They were profitable, but highly siloed. They were sacrificing scale.
In a traditional franchise, like a McDonald's, it dictates everything. The menu, the suppliers, the floor plan.
It achieves standardization and scale, but it kills local entrepreneurship. Watsco found a third way.
So Watsco is installing a global operating system, this unified technology stack, over those independent diners.
Exactly. This stack, Pricefx, Hydros, OnCall Air, and SupplySync, it does the heavy, expensive, highly technical lifting.
It allows the independent diner to buy ingredients cheaper through VCR and scale.
It allows them to serve massive corporate catering clients through SupplySync with a standardized, unified logistical and billing experience.
All while still allowing the local chef, the entrepreneurial business unit leader, to run their kitchen, manage their local customer relationships, and choose the most effective local menu.
It's the best of both worlds.
And that technological ecosystem creates a truly formidable competitive gap. They're now, miles ahead of regional non-integrated distributors.
They are. And furthermore, they offer contractor-specific, deep integration tools like OnCall Air that the major diversified distributors, like Ferguson, often lack.
Why do they lack them?
Because of their necessary focus on a multi-line distribution model that covers plumbing, electrical, and HVAC. Watsco is HVAC specific, which allows for much deeper vertical integration.
So we return to the central investment question. Does this turbulent, noisy market, the A2L transition, the housing slump, the eliminated tax credits, does this represent a long-term entry point for a long-term compounder?
I think the evidence strongly argues that yes, it does.
Because the secular growth story remains firmly intact regardless of any temporary volatility.
It does. The entire HVAC installed base is aging significantly. We are looking at an estimated 92 million units currently operating that are over 10 years old in North America.
92 million.
That massive replacement cycle, driven by energy efficiency standards and end-of-life failures, is just a powerful engine of sustained growth. The current cyclical trough is temporary noise against that long-term trend.
And the growth runway, powered by their internal technology, is immense.
Huge. Digital adoption, measured by customer use of e-commerce tools like OnCall Air, is currently only around 30% across their customer base.
Only 30%.
And management estimates that their current digital investments already provide an estimated $750 million sales benefit and $70 million in annual margin contribution.
So just imagine what happens when they double that adoption rate. If they can move from 30% to 50% or 60% adoption.
The incremental sales and margin contributions are exponential. The runway for earnings growth driven by internal technology adoption, rather than just a market share gain, is clear and massive.
So the current volatility, it's a critical strategic opportunity.
It is. By maintaining that zero debt balance sheet, Watsco is perfectly positioned to scoop up weaker, capital-constrained competitors at attractive multiples, while simultaneously focusing internally on hitting those 10, 30, and 5 targets.
The anticipation is that the market achieves a level of serenity sometime in 2026.
Right. Once the A2L regulatory transition is digested and consumer confidence begins to normalize, Watsco will be structured to drive accelerated earnings growth from its technology investments without the current frictional costs and volatility.
So while the stock is undeniably trading at a premium,
It is, but its combination of a proprietary technological moat, its aggressive strategic execution toward collaboration, and the powerful decades-long secular growth trend makes it a uniquely positioned compounder. They are just playing a different game than their competitors. #outro.
So to summarize the mission, Watsco is laser-focused on executing the 10, 30, and 5 plan. Every new initiative, VCR, Hydros, and Supply Sync, is meticulously designed to be accretive to both growth and margin simultaneously.
And it proves that collaboration built on a bedrock of centralized data can deliver superior results.
It is a remarkable model of distributed entrepreneurship backed by unified intelligence.
It is. But as we conclude this deep dive, let's leave you with one final provocative thought that builds on Watsco's strategic move into servicing plumbing and HVAC dual-trade businesses.
Okay. We briefly mentioned that Watsco has started acquiring these dual-trade businesses, like N&S Supply, which expands their scope beyond pure HVAC distribution.
And this move is strategically timed to intersect with a massive upcoming regulatory shift in water heating technology.
So new government standards will soon mandate the widespread adoption of high-efficiency heat pump water heaters.
And critically, these heat pumps contain a refrigerant-using compressor. That's a technology traditionally handled exclusively by HVAC contractors who are licensed to deal with refrigerant.
So the question for the future of residential infrastructure is this. Will the established HVAC contractor, armed with refrigerant expertise and supported by Watsco's tools like OnCall Air, will they ultimately win the new high-growth market for water heating installations?
Or will the traditional plumbing wholesaler dominate the segment? And how effectively can Watsco leverage its unique hybrid distribution model servicing both trades through its unified platform to capture this entirely new segment of the market?
That is a strategic dual-trade opportunity that remains fundamentally untapped.
That is a critical infrastructure question to ponder as this deep dive concludes.
Thank you for joining us on this deep dive. We'll be back soon with more investigation.